Good afternoon, ladies and gentlemen. Welcome to Business Bites. My name is Henry. I'm here from the Kent Invictus Chamber of Commerce. I am absolutely delighted to be joined by Jemma Puttock from Azets today. She's going to be delivering this session on inheritance tax and the upcoming changes. If you do have any questions throughout the session, please feel free to put these into the chat and then we will address these in a Q&A at the end. So I'm now going to pass you over to Jemma. Over to you.
Great, thank you so much. Hi, and welcome to the Inheritance Tax and Upcoming Changes webinar. My name is Jemma Puttock, and I'm a Senior Manager for Azets. I've been part of the tax department for just under 9 years, working regionally across the South East offices. I'm ATT CTA TP qualified and specialise in inheritance tax, trusts and estates, where I provide support and advice for our clients across our offices, alongside leading our regional trust hub, specialising in all things trusts. There's a lot to cover, but I will do my best to keep the presentation to half an hour. If anyone has any questions as a result of the upcoming talk, I'm more than happy to stay on at the end, like suggested. Otherwise, my email address should be on the slide coming up now. Right, now I think we were all expecting some changes from the autumn budget, and the general feeling was towards capital gains tax. And although there were some changes here, the budget delivered some significant changes for inheritance tax, especially regarding agricultural property relief and business property relief. So today I'm going to briefly chat through those changes and what this may mean, together with some planning options that may be available or worth consideration to help mitigate potential inheritance tax. An important point to stress is that we are still waiting on draft legislation to be made available, and so this is all based on guidance that has been made available to date. However, consultations have been undertaken, and we are hoping that details from these consultations, together with the legislation, will be made available shortly. So, looking at a brief recap of the basics, what is inheritance tax? Inheritance tax is typically a tax suffered on the value of the estate of someone who has died. However, it also takes into consideration any lifetime gifts that the individual has made within the 7 years prior to their death. Typically, when calculating inheritance tax due, we aggregate the value of all assets within an individual's estate, such as property, savings, investments, and deduct available liabilities such as mortgages. If there are any assets in the estate which are passing to a surviving spouse, those assets are exempt by a spousal exemption and so are free of inheritance tax. We also deduct the available nil rate band for an individual, which is currently £325,000, although the available amount may be reduced depending on any lifetime gifting made in the previous 7 years. In addition to the nil rate band is the residence nil rate band, which is available where an estate holds residential property, which has at some point been the deceased home, and this is being closely inherited, such as by children and grandchildren, including adopted or step-grandchildren. The residence nil rate band is only available if the gross value of the estate is under £2 million and is reduced accordingly by £1 for every £2 over this threshold. However, before we deduct any available nil rate bands and resident nil rate band exemptions, we consider what inheritance tax reliefs are available to the estate. So for clients with trading businesses, that tends to be business property relief, BPR. And for farming clients, that's agricultural property relief, APR, and also potentially BPR. Once those exemptions have been considered and deducted where available, we are left with net taxable value of the estate, which in most cases is subject to inheritance tax at 40%. So the key reliefs are the most common, being agricultural property relief and business property relief. Prior to changes announced in the budget, most businesses and active farms would have been relatively sheltered through APR and BPR. Looking at APR, this relief is available on the transfer of agricultural property. The definition is shown on the slide, being largely any agricultural land and buildings that are used within the farm. This would be your arable, pastoral and mixed farms, the farmhouse, farm cottages, and any buildings linked to those activities which would likely qualify for APR, subject to certain conditions being met. As a side note, from April 25, land managed under environmental agreements will also qualify for APR. There are two different rates of relief. In most cases, where there's an active farming family who farm the land in hand, 100% relief will apply. For any farm business tenancy agreements and grazing licenses, it is likely that full relief would also be available. Any land let on a pre-1995 tenancy would only be subject to 50% relief. So APR is available on the transfer of agricultural property, which is important to remember. For example, land may be owned that has additional value to the agricultural worth, such as development value or mineral value. In these cases, the value in excess of the agricultural value, so the difference between the market value and agricultural value, would not be covered by APR. Here we would try to cover the gap between agricultural value and market value with business property relief. So first we look to see what would be covered by APR as a whole, and then we look to see if there's any value not covered by relief and whether the remaining value could be able to be claimed with BPR, such as stock, plants, machinery, plants, and any buy-to-lets. Business property relief is available on the transfer of business property, and the crucial element here is that the business needs to be wholly or mainly trading. Investment businesses will not be eligible for relief. Now, determining whether a company is wholly or mainly trading can be quite a subjective area, and when looking at whether a business qualifies, we would be looking to see if the business trading activities were over 50% of the overall activities of the business. Whether a business is trading could be a bit of a grey area. For example, farms with multiple buy-to-lets, glamping sites, caravan parks, or solar panels. Here we'd have to look at the overall activities undertaken within the business as a whole to consider whether the trading element would be met. Such aspects would be what the turnover is, what kind of assets are held, are employees being largely used in the traditional trading activities of the business, or are other areas being looked at which is more investment type. The main question is, where is time and money being spent? And if you're considered to be wholly or mainly trading, you'd qualify for 100% BPR on the business, the partnership, or shares in an unquoted company. Business property relief is also available on buildings and plant and machinery that is used in the business but personally owned. However, relief here is restricted to 50% instead of the full 100% value. It can be really important to consider and review how assets are owned, and we often find that, especially with trading partnerships, some assets used for trade are actually still personally owned, and so full relief isn't available. A separate potential problem for BPR is the anti-avoidance provisions for accepted assets. An asset is generally an accepted asset if it was not either used wholly or mainly for the purpose of the business for the 2 years immediately preceding the event, or not required at the time of the event for future use of the business. If such accepted assets are held, BPR is restricted by the value attributable to that asset. One prime example here would be excessive cash funds held in the company that are not earmarked for future use. In addition to qualifying as relevant property, it's also important that the donor has held the property for the qualifying period. So for business property relief, this is 2 years. For farmers, if the land is farmed in hand or through a partnership, the period for APR relief is likely to be 2 years. If the land is tenanted, for example, you own some fields, but they're being tenanted by another farmer, that period extends to 7 years. So in most cases, you're looking at a 2-year period. So previous to the October budget, we would have some valuable businesses that would have been mainly sheltered by APR and or BPR. From April 26, these businesses are going to be far more exposed to inheritance tax. From 6th of April 2026, a limit is going to be in place on the 100% rate of relief that is available for both APR and BPR combined. Relief at 100% will be available on the first £1 million of APR and BPR qualifying assets, with any excess value received relief at 50%. So, for example, we have a business worth 4 million. The first £1 million would be covered at 100%, and the remaining 3 million value is likely to only get 50% relief. So there's potentially £1.5 million of excess value that is now exposed for inheritance tax purposes. Again, just highlighting that we are still waiting on draft legislation to be made available to confirm the exact mechanics behind the proposals announced. From the guidance provided today, it is looking likely that any unused £1 million allowance from an individual's estate will not be transferable, unlike the nil rate and residence nil rate band, where any unused amounts can be claimed by the surviving spouse's estate. This will be very much a use it or lose it position, so it may be worth reassessing ownership and making sure relevant individuals are utilising the available £1 million allowances. In addition to the major changes to APR and BPR, there are a few other changes of note. There was a freeze on the inheritance tax threshold. We have the nil rate band of £325,000 and the residence nil rate band of £175,000. These were originally frozen until 2028, but this has now been extended to 2030. So no capital appreciation or any inflationary increases will see any benefit here at the moment. There were some considerations as to whether the time window for gifting would change from a 7-year position to a 10-year position, but this has not changed as of yet, and so lifetime gifting is still subject to the 7-year window. In addition, there were discussions as to whether the market value uplift for assets inherited on death would be removed. This would have been an enormous change for most people, but luckily the uplift to probate value has remained in place. Another big change was in respect of pensions, which as from 6th of April 2027 are now within the scope of inheritance tax. We've got many clients who have large untouched pension funds, as previously that was the most efficient thing to do for IHT purposes. However, with the changes coming into play, we're now having conversations with our clients and strongly advising that they also have conversations with their financial advisors about the overall impact of accessing those pension funds during their lifetime. There could potentially be merit and overall tax savings in starting to draw on those pension funds and possibly being able to make gifts out of excess income or just enjoying the additional funds instead of the value being left in their estates to suffer inheritance tax, and then for the beneficiaries to then suffer income tax when they draw down on the pension funds. There are various transitional rules and anti-forestalling rules that will now apply to the new allowances. The table on the slide sets out the implications of making a lifetime transfer and how these are impacted with the new allowances and changes to relief. As you will see, any lifetime gifts prior to the budget day will not be affected by the changes announced. So no changes to any APR or BPR position on that gift. The relief here is uncapped. Any lifetime gifting made after budget day and where the donor dies before 6th of April 26, when the new allowances come into play, will also not be affected, subject to those assets still meeting the conditions for relief. And so relief should still be available. Any lifetime gifts made post-budget day and where the donor survives until at least 6th of April 2026, when the new allowances come into play, will be affected. So the first £1 million of value will have 100% APR/BPR, with the balance being relieved at 50%. So a huge part of our planning here going forwards is looking at what kind of lifetime gifting should be considered or whether there are any efficient structures that could be put into place. Now with gifting, we also need to be careful to consider capital gains tax. For example, if I had a £200,000 property, which I bought for £100,000 and then gifted it to my daughter, I would crystallise a gain of £100,000 irrespective of whether I received any money for that gift. A handy relief available for business and agricultural assets is called holdover relief. And this relief allows you to transfer the property to another individual, deferring the capital gains tax charge arising by the recipient taking on the original base cost. Now, this does mean that when the assets are eventually sold, there is potentially a larger gain to be taxed. However, the recipient here has the funds to settle the tax due, whereas on a gift of the assets, there are no funds being received to cover any tax arising. So holdover relief doesn't remove capital gains tax due, it simply defers it until there are funds available to settle. I would caveat that previously furnished holiday lets would have qualified for holdover relief as business assets, but this is changing in April this year and the relief will be removed. So if you have any furnished holiday lets that you would consider transferring to family members, this needs to be expedited to see if it can be accomplished before 5th of April 25. So having chatted through the details of the main upcoming changes to inheritance tax, which can be quite complex, I thought it best to show a few working examples covering some different scenarios. Here we have Mr. and Mrs. Green, who are both 60 and are partners in the family farming partnership. We have a typical structure where on the first death, the surviving spouse will inherit the deceased estate. And we've got assets held in trust by Mr. Green on behalf of the partnership. And as these are not personally owned by Mr. Green, they would qualify for 100% relief under either APR or BPR. The example has everything passing from Mr. Green to Mrs. Green, and so the estate will benefit from spousal exemption, and as such, there's no immediate inheritance tax charge. In addition, as Mrs. Green is inheriting the assets from her spouse, the BPR and APR status is also retained, so we don't need to worry about the 2-year period of ownership clock being restarted. The farmhouse and buildings qualify for APR, and you will see from the table on the left that we have agricultural land that is purely agricultural value, so £3.5 million relief right there. The farm building valued at £400,000 again would qualify for 100% relief. The market value of farmhouses will be worth more than their agricultural value, and so relief is restricted accordingly. The remaining assets within the partnership are covered by BPR, such as the rental properties and current account. Now, with the rental properties, because the partnership is wholly or mainly trading, the value of the rentals would be chargeable if held outside the partnership. But because they form a business asset and the business is wholly or mainly trading, BPR is available, sheltering the value from inheritance tax. So it's an interesting point to consider if you're holding any kind of buy-to-lets or rental properties outside of a wider business. Looking at the table here, we have a gross value of £5 million and relief available of just over £4.5 million. So the chargeable value of the estate is £450,000, and Mr. and Mrs. Green will have two nil rate bands to offset against that value of £650,000, resulting in no inheritance tax liability actually arising. So £5 million estate with no actual inheritance tax liability pre-budget. Post-budget, from 6th of April 26, the position is substantially different. Going through the example again, on the first death, assets pass from Mr. Green to Mrs. Green, and we claim spousal exemption. Again, no immediate IHT charge, but by passing those assets from one spouse to another, Mr. Green has lost the use of his £1 million APR/BPR allowance and increased the value of APR/BPR qualifying assets now held by Mrs. Green. For simplicity here, we've knocked the £1 million allowance from the agricultural land. So against the land value of £3.5 million, we have £1 million of relief at 100%, and then the remaining £2.5 million of value receives relief at 50%. So total relief of £2.25 million, which leaves £1.25 million of chargeable value in the estate. So where this value was previously sheltered, that is a significant change to a significant amount. Again, the farmhouse, buildings and rentals will receive 50% relief. So rather than the 4.55 million previously, the relief has reduced to just under 2.8 million. We now have a chargeable value of just over 2.2 million, and we deduct the husband and wife's nil rate band. You will note that we are not taking any deduction for residents' nil rate band because the gross value of the estate is £5 million, so significantly over the 2 million threshold where this relief starts to be tapered away, and so this is another valuable relief lost. Also, after deducting the available relief, we have a taxable estate of just under 1.6 million, which is taxed at 40%, resulting in IHT of £630,000. So from a nil IHT liability to £630,000 is quite a substantial change. There are suggestions this liability may be settled over 10 yearly instalments, which may be interest-free, but as with other areas, we are waiting on further guidance on this. At the moment, HMRC's interest rate is 7.5%, so quite a costly way of settling inheritance tax due if you're charged interest on the outstanding amount. So what can we do? Well, in most cases, it's going to be lifetime gifting and will planning. A combination of making sure your will is correctly structured and written, and then looking at lifetime gifting to try and transfer assets from the older generation down to the younger generation and wider family. Looking at the example here, Mr. Green makes a lifetime gift of his shares in the farm to his son. His partnership share must be commensurated with the work he undertakes, and this is an important point to make sure gift with reservation of benefit rules are not triggered. This is where if you're looking to gift assets, you need to ensure that you no longer benefit from those assets gifted away in future due to the anti-avoidance rules, which will negate the position for IHT planning. In this example, we are gifting the whole share in the partnership, but in reality, we would most likely look at quantifying the inheritance tax liability first, and then looking at making a gift of maybe part of the farm or some of the assets within the partnership. Looking at the table on the left, we have gifted £4.6 million of value, and if Mr. Green survives a 7-year period, that gift falls out of his estate and there is no IHT exposure. So a similar position pre-budget. If, however, Mr. Green dies within 7 years of making the gift, then there will be an inheritance tax position to consider. What happens is the value of the gift comes back into charge within Mr. Green's estate. Now, it's not the value of the gift at the date of death that comes into charge, but the value of the gift at the date it was made. So even if the 7-year window has not been achieved, it can still be a way of mitigating inheritance tax on assets such as land and property that generally appreciate over time. In this instance, the gift is valued at 4.6 million, and we claim APR and BPR in the same way. So just under 2.8 million of relief is claimed against the gift, and we use Mr. Green's nil rate band, giving a net chargeable value of just over 1.5 million. If Mr. Green does not survive the first 3 years following the gift, we have an inheritance tax at 40% being £620,000. But within that 3 years, we've not had IHT on any appreciation on value on the gift that's been made. If Mr. Green can survive between 3 to 4 years, the IHT exposure reduces to £506,000, and if he can survive 6 to 7 years, the combined IHT position with Mrs. Green reduces to £134,000. Having discussions around lifetime gifts can be really important, as it can be a way of significantly mitigating potential inheritance tax. However, one point I would stress is that we need to be careful that the right decisions are being made, and that fundamentally the personal wishes are being met with the best possible tax position in place. A couple of further comments to add to this example of gifting. By making a gift of the whole farm to the son, we're not utilising Mr. Green's £1 million allowance or Mrs. Green's allowance, and it could be worthwhile considering that life assurance to cover any potential inheritance tax that could arise during the 7 years from gifting. We also need to think about other taxes. As previously mentioned, is there going to be any capital gains tax implications by making the gift? There could also be stamp duty, land tax to consider, so there's plenty to consider there. Another really important point is that we are now potentially causing the son to have an inheritance tax issue, as well as assuming the son will outlive the father, which is very much putting all your eggs in one basket scenario. We ideally want to make sure that everyone has an IHT position that is as efficient as possible. So we could look at spreading the value across the family or using a family trust. Another quick example here, just to show the position of an uncrading trading company. Here we have shares worth £5 million, and pre-budget these will be covered by 100% BPR relief, so no inheritance tax due. After 6th of April 26, the shares will attract 100% relief on the first million, leaving 4 million subject to 50% relief. Therefore, IHT of 800,000 will be due on a chargeable value of 2 million. So post-budget planning is really important. Obviously, we need details of the legislation and consultation to give finer detail, but the first steps is having conversations to see what could be considered. It will be invaluable to understand what potential inheritance tax position estates may face, and I would encourage anyone to check and confirm who owns what, together with checking ownerships of assets within a business so no nasty surprises crop up. For example, have you inherited any assets? Do you know what value you inherited them at? What's their market value now? Check partnership agreements and review your wills. Do these gift all assets to the surviving spouse, or do they make use of the nil rate bands? It's a really important time to stop and take stock. Think about the wider plans for the business, the wider family position. Consider protecting the business and the legacy, as well as securing control and asset protection. So second step, once we've quantified the potential inheritance tax position, is to look at engaging in proactive lifetime planning where appropriate. Can we gift or transfer some value to maximise the £1 million allowance across the family? We also want to consider that we are creating access to both the nil rate band and the residence nil rate band across the estate as a whole for spouses, which can on its own provide relief up to £1 million. Another point that needs to be considered are what assets should be gifted. Are there certain assets where it would make more sense to be gifted to a younger generation, such as property? Gifting part of the current account and the partnership can be quite an effective way to remove value from the estate and pass it on to the younger generation. Portioning assets could also be considered. So instead of giving up the whole asset, you could give, say, 50% of the shareholding or 25% of land. Family trusts can be a great tool for IHT planning and a great way of gifting to a younger generation and ensuring that multiple people can benefit. One major perk with a trust is that it allows an element of control over the assets to be retained, which is lost by outright gifting. Obviously, we are aware that some individuals may be considering selling the business and converting the value into cash. Whilst this is an option, you're going from a position where there is some relief in the form of APR and BPR to a position where you have just cash, which is subject to full IHT at 40%. So this possibly is not the best option to consider moving forwards unless there's a wider business reason to consider it. We also need to think about the personal income position. As previously mentioned, once an asset is gifted, you can no longer benefit from it in any way. So things like buy-to-lets, if you're relying on the income that derived from that asset, then gifting that asset is probably not the right course of action. In addition, following a death, it is possible to look at a deed of variation within 2 years from date of death. A deed of variation can help rewrite the will in a more tax-efficient manner, subject to overall agreement by those involved and affected. There's some potential planning examples are as follows. Here we've got a gift of shares. The idea here is a simple gift of shares from the shareholder to the family using gift holdover relief to mitigate capital gains tax. It's a simple strategy to help move value out of the estate on the assumption the company structure is fairly vanilla and not complex. The gift would qualify for holdover relief, so no capital gains tax due. However, capital gains tax would come back into charge when and if the shares are later sold. Again, a slightly larger gain would arise, but there would be cash there to settle the tax due. One element to consider and briefly touched upon is that if there are non-trading or non-qualifying assets within the business, then the gift holder relief could be restricted and a capital gains tax charge could arise on the value of the assets that would fall outside relief. For example, a business is worth £6 million with qualifying business assets of £4 million and a rental worth £1 million. The rental property would be a non-qualifying asset, so we would take the £1 million over the total value of the business assets being £5 million, generating a 20% restriction. So for a £6 million company, which includes the value of any goodwill, a 20% restriction is £1.2 million that would be subject to capital gains tax. For inheritance tax, there would be no immediate charge, and this would be subject to the 7-year rule. Obviously, the capital gains position is not ideal if the company is either non-trading or has non-qualifying assets. So is there a way to mitigate potential capital gains tax? We could consider using a trust. Here, instead of an outright gift to the shareholder, gifts of the shares are made into a trust for the benefit of the chosen beneficiaries. Should the trustees choose to do so, the shares can be gifted out to beneficiaries at a later point. Gift holdover relief can apply when assets are gifted into trust, and here there are no restrictions for non-trading assets. So even shares in an investment company or rental properties could be gifted into trust with no immediate capital gains tax liability. The reason that capital gains relief is so generous is because the transfer into trust is a chargeable lifetime transfer for inheritance tax. This is where lifetime tax at 20% is due on the value of the assets settled, which exceed the settler's nil rate band. For trading businesses, if shares are transferred into a trust pre-6 of April 26, full BPR relief should be available, and so in essence, no lifetime IHT will actually be paid. We would recommend that the trustees hold any trading shares for a minimum period of 2 years before considering appointing shares out, just so that if the shares were from a trading company, the shares held by the trust would then qualify for BPR relief. Gifts out of trust are exempt for capital gains tax, as holdover relief can once again be claimed. For IHT, an exit charge would arise. However, the maximum charge is 6%, which is in line with the 10-year anniversary charge rate. Therefore, if the shares are transferred out of the trust after 2 years, the effective rate of tax to get shares into the family's hands is less than 1%, which is considerably less than the potential tax position on the £1.2 million discussed on the previous slide. If the shareholder doesn't want to give away shares in a company that they've worked hard to build up, preference shares could be considered. Here, the shareholder sells shares in the trading company in return for preference shares in a holding company. In this transaction, other family members offer to buy the shares from the older generation for a mix of consideration and preference shares. Provided the transaction is structured correctly, there should be no immediate CGT charge for the preference shares received, and no IHT to consider, as this is not a gift but a sale. Stamp duty will be payable at 0.5% and is usually payable by the new company. Preference shares, even though non-voting, retain BPR status and so are great for future IHT relief. So putting this into an example, we have Mr. and Mrs. Smith, who own 100% of the shares in trade company worth £4 million. Son and daughter offer to buy the shares via their own recently incorporated company, seen here as Hold Company, for consideration of £2 million cash and 2 million preference shares. We would request HMRC clearance to confirm the transaction is a share-for-share exchange transaction on the preference shares, and therefore capital gains tax on the shares would be deferred. Mr. and Mrs. Smith now have £2 million of shares covered by BPR relief and £2 million of cash to go off and enjoy. I personally think a round-the-world trip would be money well spent. Now, the great thing about preference shares is that they can be redeemable. So if future cash is required by Mr. and Mrs. Smith, they can redeem a portion of their preference shares but pay only capital gains tax on the original amount deferred, which would be lower the rate than tax taken on dividends. If the preference shares do not need to be redeemed, the preference shares could be transferred to son and daughter on death and BPR would apply. The transfer of shares on death means that the children get a capital gains tax uplift, and so son and daughter could redeem the shares for very little or no tax. Another option is growth shares. Here, the value currently held in the senior members' hands are frozen, ensuring growth flows into the hands of the wider family and next generation. The existing shareholdings are converted into 2 classes, taking into account the current value of the company. We cap the value of the capital ordinary shares, and then the growth shares take over future growth of the company. Primarily, it allows a low value of growth shares to be gifted either outright or into trust with very little or no initial tax impact. The capped ordinary shares are kept, which hold voting rights and power to run the company, with the growth shares having no element of control. These capped ordinary shares will have a fixed value, which also allows future planning, for example, if senior family members wish to reduce their estate further. Furthermore, the company's articles can be changed at a later point so that if senior members wish to take value out of the company, then every time a dividend is taken, it reduces retained rights to retained capital, which then helps to reduce IHT exposure. Finally, I wanted to briefly touch upon family investment companies. These have been around for some time but can be really effective if used correctly. Here, a standalone company is created which holds and acquires investments for the benefit of family members. The important factor here is the share structure. Again, we have capped ordinary shares with the senior family members and growth shares for the younger generation that have no voting or restricted voting rights. Ideally, senior family members, i.e. mum and dad, lend money to the structure and this IOU remains in their estate. The income and value here does not flow back to them, but instead grows with the growth shares held by the children or grandchildren. It's similar to the previous scenario where it caps the value associated with the senior members. If money was invested into property, the income would be taxable by the company, albeit at a slightly lower rate than personal income tax. If you invested in equities and had a dividend yield instead of a mix of a yield and capital gains, then the company tax on the yield is 0%, whereas with individuals, it's nearly 40%, which potentially provides an income tax saving as well as inheritance tax. An important point here is that the senior members of the family can retain control, which protects the assets from potential divorce or bankruptcy or other family issues. So when would you use a family investment company? Ideally, when you have existing wealth that is invested personally and it's inefficient having investments in your own name for income tax purposes as well as inheritance tax purposes, or potentially following the sale of a business or management buyout. So that's the end of my presentation. Hopefully I managed to keep to the right side of 30-minute mark for everyone, but I do apologise if I've gone over slightly. I'd like to say thank you for attending and I hope you found the topics discussed informative and helpful. As mentioned at the start, please do feel free to contact me with any questions or queries that you have. My details should be back up on screen now. Thank you.
Perfect. Thank you very much, Gemma. What a super informative session that was. It's quite clear and evident from listening to that there's going to be a lot of changes happening, and staying as up to date and in the know about those as we possibly can is definitely important. We do have some time if anyone would like to ask a couple of questions. Hayley, I know you put a comment in the chat. Hayley Kingsnorth, I was wondering if you wanted to unmute and ask away. Sorry, Hayley, were you wanting to ask? I can ask it for you if that's easier. So Hayley commented, as the rules for BPR are same for holding shares in a company, what age can a child own shares outright in a family company if the parents were to make a lifetime gift?
So if parents were looking to make a lifetime gift to their children, they want to be doing that once the child is no longer a minor. So once they turn 18. If you give shares to minor children, then that creates tax implications for the parent and there's no real benefit. So you want to be waiting for them to turn 18 before they receive those shares.
Perfect. Thank you very much, Gemma, and Hayley. Thank you very much for your question. Did anyone have any other questions before we conclude the session today? If so, feel free to unmute and ask away. No, I think we are there in that case then. Um, like Gemma mentioned, her contact details were on the slide there. This session has also been recorded, so if you were wanting to take another look or had any further questions, feel free to ask Gemma, and equally keep an eye out for the recording that will get sent to you on the back of the session once it is all sorted. Firstly, I would just like to thank you all for attending today's session and taking the time out of your lunch to come and learn a bit more. Secondly, Gemma, again, like I said, massive thanks for such an informative session today. And finally, I've been Henry from the Kent and Vix Chamber of Commerce. Have a lovely rest of your day. Thank you ever so much.